So I think what's not that well, I guess, understood is that the quality of the assets that are owned by some of these Asian REITs are of very high quality, if not similar to what we see in Australia, even possibly slightly better. Take for example, Mapletree Commercial Trust owns VivoCity, which is Singapore's largest mall. It sits right outside Sentosa Island, and you compare that to Westfield, Sydney. So they both very large, dominant destinational type malls. They both generate about $1 billion in sales annually. Westfield Sydney gets about 44 million in visitations every year. VivoCity gets about 55 million visitors every year. And if you compare the footprint of these two malls, VivoCity is actually a fair bit smaller. It's about 40% smaller than Westfield Sydney. But because they generate the same level of sales, the productivity of the space at VivoCity is actually about 50% more than what Westfield Sydney generates. And so I think it speaks to the quality of the assets that these REITs own. And we're very comfortable in owning the REITs and collecting the dividends that come from owning such high quality assets. So the Hong Kong office market is actually one of the most expensive office markets in the world, and with vacancy rates currently at about 1.5%, they're the lowest that you see anywhere in the world. And driving that demand for Hong Kong office space, other than the fact that the supply is very much limited because Hong Kong is landlocked, obviously, but the demand out of mainland Chinese firms, financial services and the like, really at Hong Kong's doorstep, seeing Hong Kong as a gateway to Asia, and really wanting office space in the Hong Kong market. And that's driven vacancy rates to where they are today, and driven rent levels that are continuing to increase to the tune of 7 to 9% this year in an already very expensive, very tight office market. I think to get exposure to that sort of growth via a very stable income generating investment in a Hong Kong REIT, we feel is very appealing.